Hey, welcome to Freight Forecasting on this fine Thursday afternoon. I'm Michael Vincent, freight forecaster here at FreightWaves, joined by our lead economist, Anthony Smith. How you doing today, Anthony?
I am great, and thank you for having me. Still one of the best intros in the FreightWaves media game.
Oh, yeah, absolutely. One of the best intros in the business. Nice to have you again. This is becoming a regular thing, and I like it.
I like it, too.
Very different data sets, but very much intertwined.
Right.
So I posted yesterday, and this is it's along the topic that's on everybody's mind. Obviously, we're looking forward to a recovery, hopefully an expeditious and very successful recovery in the economy, and for all those that are out of work or businesses that are hurting, that things pick up for them dramatically and quickly and get back to normal or better than normal.
Yeah.
Right.
Yeah.
But so we're seeing upticks in obviously in freight volumes. They're going up. Looks like Craig Fuller, our CEO, is going to win the bet. People keep saying he's ultimately going to win the debate, but he did not win the debate. The debate is over. It's the bet now. That looks very strong that he's going to, over Zach Strickland, our director of freight research, trade intelligence, I should say. Sorry, but so looking at this, where we're at, going up in outbound tender volumes, and if we'll bring up the screen here real quick for people to look at, this is what I posted on LinkedIn yesterday, and the conversation is really, what are your thoughts? Are we going to see, or are we riding a swoosh wave recovery right now, or are we on the first peak of multiple W's? Are we on the upside of what's going to ultimately be a V-shaped recovery? Where are we at? And if you think that we are, looking at these volumes, what do these economic indicators mean that I have on this screen here? And this is just an example to show what's going on, right? So you have in the center there the outbound tender volumes, and you can definitely see that there's an uptick there. There's no doubt about it. If you take it out to look at it a year, it's still pretty decent where we are for a year-long trend, pretty high up there. But when you look at these other things, industrial production from April is awful.
Right.
Absolutely just off a cliff. Orders, durable goods, off a cliff. Manufacturing, new orders, off a cliff.
Yeah.
Way down. Consumer credit outstanding, going up, not necessarily a good thing. People could be overextending themselves.
Right, exactly.
And unemployment rate is really high.
Yeah.
And how many? What were the new numbers today that we talked about?
Another, I think it was 2.3 million. So bringing that 9-week total up to somewhere around a 38.5, 39 million estimate right there.
Right. And what will be a better indicator, or I guess a more specific indicator, or a little bit, I don't know, a more solid direction indicator, I guess? Will be coming out soon?
Yeah. So showing whether or not there is a recovery trend going on, continuing claims. And so continuing claims comes out with
unemployment claims.
Comes out with initial jobless claims, and that shows people that are still unemployed and receiving benefits. And so that's going to be one of the first things to turn that we can expect to see if there's any kind of momentum or any kind of recovery within the job market.
So that's just one data point that would show. So if that is actually up, that would be an indicator that the recovery isn't so strong.
Right, yeah, if we're starting to see.
Or one indicator of it.
Yeah, one of the indicators that the consumers aren't quite getting back there just yet. But this indicator is, so the initial jobless claims releases every Thursday, and this is going to show for the most recent week. Continued claims are going to show for 2 weeks ago. So it's a little bit lagged, not as an exciting indicator as many would like to see with the initial jobless claims, because as those spikes that we saw early on, but definitely one that's going to be telling.
So to set that timing right, when does that come out?
It comes out every Thursday. But
the 2-week does?
Yeah.
Or the sustained?
The continued jobs claims. It comes out every Thursday, but it's on a 2-week lag, so it doesn't show last week.
So the one that will come out today will show 2 weeks ago?
Yes.
I got you.
Yeah.
Okay. So that was really just at the very beginning of things opening up.
Right. So that could be turning around now, so we can expect to see that maybe.
That could show bad, but we're still in good. So really, next week's and the weeks after would be a little bit more telling, I would think. Right?
Correct.
Yeah. Okay. So, other thoughts on this. So the premise that I was looking at was, and what I said on there was, and I can't remember exactly what I wrote because it was smart, and I'm not usually that smart. It was good though. It was it was a stroke of brilliance. Like, I got to write that down quick. Was really that, okay, when you're looking at these times right now, seasonality trends in trucking, year-over-year trends and stuff are out the window because it's just, it's a black swan event, and different events happen and outside forces happen that you're not expecting, right? But they're within this realm where seasonality and different macroeconomic indicators and so on are still very, very useful.
Right.
When you have a massive black swan event like this that we've never seen, right? Except, well, right, 9/11.
Right.
But you see something like this, which is worldwide, it throws all that out the window. So it's like seasonality year over year, forget it, doesn't matter. Produce season started hitting, really didn't have that much of an effect, right? It did a little bit, but I mean, it's such a massive black swan.
Yeah.
It killed it. And when you're looking at macroeconomic indicators, at least in my mind, and I'm not an economist like you are, or one at all, actually, is I see these as these kind of indicators of what happened that verify trends and verify positives and negatives, so you can get away and decide whether you were good. And I know you're going to talk to some of that. Please do to expand on that with some intelligence instead of my ramblings, but
doing a good job.
And then there's some that are forward-looking, right? That help a little bit more,
right?
And then there's immediate real-time data of what's happening right now, and it feels like right now, like in sonar, these data sets that are in sonar are of the utmost importance and of really the best value right now. Is that fair to say, or what are your thoughts on that?
Yeah, it's paramount because it's like when you're looking at those forward-looking indicators that we have, like say new orders. These are expectations. I know Zach Strickland hates the sentiment indexes that show things that it's not tangible data. I get it, Zach, if you're watching. I know you're watching. He's watching. They're not tangible data sets. So it gives you an idea, it gives you a trajectory, but it's not tangible. What's already happened, it's in the past. There's benefits, but it's already in the past. You need to act today. And so you can see what's happening real time. So that's when we're looking at, for example, the outbound tender rejection, outbound tender volume index. What's happening right now? What's on the ground? What are volumes doing? What's happening with capacity? That's really telling.
Well, and those are actual things that are happening.
Yeah.
And if Zach were here, I'd argue with him, like I have for the last 20 years, is how we communicate.
Yeah.
And some of our best arguments are first thing in the morning, get the blood moving.
Yeah.
We'll just take the opposite opinion just for the heck of it.
Yeah.
But the non-tangible sentiment index, they're not walking out on the streets of New York or Chattanooga or Bald Knob, Arkansas, and just asking random people, what do you think about industrial production?
Right.
These are people in the know sentiment.
Yeah.
So I think it's a little bit better than just a, meh.
Yeah, exactly. Yeah, and like I said, it's telling. It just shows the direction. And if we compare it to historical trends, there's typically a pretty good relationship between the two. It's not always one-to-one, but it's really telling to see that when we're looking at new orders that they're still down this far and that we haven't seen any kind of spike up or uptick just yet, because that's going to be talking to what we can expect real time when these orders get pulled forward. Right,
exactly. And so you're looking at these new orders, it's a dumpster fire.
Yeah.
And I think I said that in the article. We look at these and these don't mean anything. If you go back and I want you to argue with me here, because this is kind of like what I hear from people when I'm talking, and even in my own limited knowledge of macroeconomics, I look at these and I say, okay, back in here when I'm looking through these numbers here, and let me make this a little bit bigger here so people can see this. So when I'm looking at these numbers right here, right?
Mm-hmm.
I can follow this trend.
Yeah.
But then this huge black swan event happens and this goes down. Well, now this data point here doesn't mean anything to me. Everybody knows April was a dumpster fire.
Yeah, yeah.
Right? So now where do I go?
So that's when you start to look at, you can look at some of the forward-looking indicators. And so this is
we can pull some of those up.
We can pull some of those up, but so I can.
You want to grab them or you want me to do it?
I'll pull up an example here.
But you can do it right on this chart if you want
this chart here is good?
Sure.
Okay. So for example, let's pull up iProG.USA.
You got iPorg.
Oh, iPorg.
IPROG, which
I've used
is
this
what is that?
platform.
Industrial production.
Industrial production. This is the whole thing. This is
Year-over-year
growth for industrial production.
Okay.
And we're gonna back this out, and we can see the ups and downs all the way back to 1920 something, you know. But we're gonna zoom in a little bit here, get a little bit more. 5 years. Let's back it out a little bit more. Maybe so we can see the last cyclical recession
No, we're
in
good.
08, 09. So let's see here. I can definitely do this with one hand, I'm telling you, Vincent. So, okay, perfect. We can see that,
Here we go,
huge
yeah.
drop in 08,
Absolutely.
09.
Yeah.
So what we can do is pull up a comparison here with the ISM.MNew. Let's change up the color.
So that's Institute Supply Chain.
Institute for Supply Management.
Supply management. That's
purchasing
manufacturing
managers.
new orders, right?
Yep, these are new orders for that index, and so we can do a comparison here. Add it. We'll look at it on a. Do we have dual on? Perfect.
Yep. There it is.
So what we can see here is that there is a pretty significant trend when new orders tank.
Yep.
Industrial production tanks.
Absolutely.
Typically, new orders tanks before, and it hits that trough, as we can see there in 2009, or late 2008, early 2009. It hit that trough before industrial production did, and then we saw that subsequent decline for industrial production. Then we saw that rise early on in new orders. And if we go back here, we didn't see that rise yet, just for industrial production.
Exactly, and in previous shows we talked about this and compared it with flatbed moves.
Right.
Right. So so you have the MNew, IPROG, flatbed moves, then follow that, and then beyond that, the rest of the economy really starts to. You can see that influx of van and refrigerated and everything else start to pick up as well. Those are the leading indicators.
Right. And so now we see this huge drop in new orders. It's at that trough. We haven't seen that subsequent rise just yet. So that's telling us that can we really expect industrial production to start kicking back on any minute now? Not so quick, because historically speaking, typically we would have seen a rise in industrial or ISM new orders, even though it's not a tangible sector or measure. It's a diffusion index. We still haven't seen that rise yet in new orders.
Yeah, so diffusion index is a survey.
Yeah.
Right? Okay. So that's Anthony Smith talk for.
They didn't ask me, but they should have.
I got you. Yeah. So so we've got to wait for this. We've got to see this for this particular thing. Right now, the indication is that not so sure.
Right.
Right. So and then you're looking at unemployment that it is down.
Unemployment's down.
That's not necessarily a positive.
Right.
So if you're looking at these type of things, so if we bring in, say, maritime, and I look at what's being imported by industry sector, et cetera, in this particular one here, and I've got it kind of goofed up here because I want to be able to show this, is, we saw this huge spike back here in imports.
Yep.
Right? That was backlog coming in, and Greg Miller, senior editor maritime for FreightWaves and American Shipper, even talked about this. There's going to be a cliff, and he was talking about it when it was way up here, and it absolutely was. Then we saw this kind of tick up, and now it's dropping again.
Right.
Right? And if we do this, I could look at this. So this is durable goods.
Yeah.
That's not. So what do durable goods tell us?
Durable goods is
that's
typically
lifetime more of 3 to 5 years, right?
Yeah, 3 years or more. It's considered durable goods, non-durable, 3 years or less shelf life.
Right, and then I've got everything else. I've got it by industry here. So here's your daily change.
Yeah.
Right. So so I can look at this. So daily, okay. Well, daily is daily, right? I mean, it's okay. Things tick up and tick down, but I can change this very, very quickly, and look at weekly.
Yep.
Any better?
Right. Right. Yeah.
Right. Yeah. And then I look at this and go, monthly, not so good.
Yeah.
Right.
Definitely not yearly.
Yearly is good. So I'm struggling to find somewhere where it's good. 2 week, daily. I mean, it's just across everything.
Yeah.
The imports are still down. So if there is a recovery that's going on right now, I mean, there is. I mean, there's an uptick in activity.
Yeah.
Let's call it that, right? Because in economic terms, when do you call it a recovery?
Typically, I feel safe in calling a recovery. Economists are going to differ for this, but when I see 2 checking points and at least 3 indicators, that's when I start feeling confident. Okay, there's something in the works here, that there's a recovery in the movement.
Right. So we haven't seen any those yet.
Not yet. I mean, the closest thing we have, one of the things we were chatting about earlier, is those regional Fed indices.
Right. Do we want to talk to those?
We could talk to some of those. Yeah. We have.
How do you want to pull them up?
Let's see.
Go ahead. You can take any one of these over here. You have control of the screen as well. You can take
Perfect.
one of however you want to show it.
Let's see if we can do the.
So those and they're Fed indices, right?
That's right.
And so those are. Let me try and explain it, and you can tell me if I get a passing grade or not. Right.
Yeah.
So you have the Empire State. Mm-hmm. You have Philadelphia.
Yep.
You have, is it Dallas or is it called Texas?
There's a Dallas, yep.
There's a Dallas, but there's also a regional one for there, right?
Yeah.
And is there one Atlanta as well?
There's one for Atlanta. There's one, they're all throughout the country.
Right, but they measure current business activity?
Yes.
And future 30-day, forward-looking 30-day activity.
What people expect over the next 30 days.
So these are diffusion as well?
Correct.
Okay.
And it gives a little bit more of a forward look as well. So the most recent one for the future conditions, business conditions expectations from the Empire State Index, so it looks at the state of New York and that greater region. There's an uptick here.
It's up twice because this 7.0 was April's, and we've had May's come out, which is up here at 29.1.
Yeah. So that's telling us that businesses that are in the manufacturing industry are feeling confident that business conditions are going to improve. Now, current conditions
the level that this is at doesn't mean that the level of activity or manufacturing is going to improve from 7 to 29, as if it's going up 22 basis points or 2,200 basis points, right?
Right.
It's just that they're 29.1 it's going
zero.
to improve.
Yeah, it's above zero. People are feeling business owners are feeling a little bit more optimistic about the future conditions.
So it's going to be better than incredibly awful.
Yes. I think what Kevin Hill said, less bad. It's still bad, but less bad earlier today.
Yes. Still bad, but not quite as bad. Yeah.
Yeah, so we can see that businesses or future expectations are improving. Still current conditions we saw in the index still down, still in that contractionary period or zone. Same with the Philadelphia Fed index. Did that come out? That came out not too long ago, and we also saw that we can pull up here. Let's see, Philly Fed.
That's a year-over-year change there.
General year-over-year. We have the current. So let's
future,
go future right there. That one is down right now, but the latest numbers did come out, and that did show an improvement. I think it was something in the ballpark range of a 13.5% or point improvement. So from that 50,
so it's somewhere in the 39?
Yeah,
negative 39?
Yep. And so
so let's explain that a little bit, right? Mm-hmm. So that came out. So this will be in Sonar tomorrow,
right?
So you'd have this, and you can do your comparisons and start analyzing it against everything else and what you're seeing. But so this goes 0 up and 0 down.
Yeah.
Right. It's got positive and negative. So for it to be like, hey, things are going to be great, it's got to be above 0.
Yeah. So
really, anything under 0 is still a form of bad.
It's just less bad.
Just less awful. Yeah.
Right.
Less bad. Gotcha. Okay. So that came out, and it was a little bit up.
Yeah. Correct.
So okay. I'm not getting the warm and fuzzies on this recovery right now.
Manufacturing is going to be rough. I mean, heard it. We've said it. It's going to be certainly one of the first industries to come back. Potentially, there's going to need some poking. There's going to be some prodding, some stimulus needed there. We're seeing auto starting to come back online, which is a good sign, but it's not going to be overall enough to really move the trend up. When we're looking at overall manufacturing and industrial production, auto doesn't just take up enough of that percentage. But there are really good points to expect the future conditions to get a little bit better. The thing that's holding things back right now, that business-to-business activity, that business investment.
Yeah.
We chatted with Mike Bonadisto last week, and came, we've heard left and right that businesses, business owners, executives, they're really cutting their expectations and any kind of plans for capital expenditures. And that's going to be a huge part of the industrial production segment.
They certainly are. And there was the Fortune 500 survey where I think 58% that capital expenditures would not return to anywhere near normal. Like 58% were like a year and a half out.
Right. Exactly. Yeah. So businesses are curtailing their investment, business-to-business activity, their capital expenditures investment. There's going to be some wild swings, of course. I mean, if you're involved in the manufacturing segment, say maybe you're a carrier or something like that, of course, diversifying is the name of the game. There are going to be wild swings, whether that be aircraft. You see Boeing in the headlines all the time. Defense spending, though that can sometimes move counter-cyclical. Both those two things are wild swingers, but they're things that we typically exclude when we're looking at non-defense capital goods. You do non-defense capital goods, and you do excluding aircraft. So you got to get those swingers out of the algorithm there.
Yeah, it's good to get the swingers out of the algorithm there. So I pulled up. I went back to a previous one that we went to, the orders, right? So these will come out in another couple weeks again, right?
Right.
So that's where we'll be able to see whether this is it going to be sustainable or not.
Correct.
Right, because we've got a bit of an anomaly that's going on right now. Because these are the indicators. So we've got IPROG, which is industrial production, but you got durable goods excluding defense, right? Non-defense capital goods, et cetera. There's more, but these are the ones that I put up there. And then you've got actual production.
Yeah.
Right. So these are orders, which are tangible.
Right. Right.
And this is actual production activity over here. So these are the tangible indicators. And if they're not setting a 52-week low, they're on the way to, as indicated by the red.
Yeah.
Right. This red is 68,903 because this is colored red here, right in this area. It means that it is decreasing.
Yeah.
It would be green if it were growing. So this one's going down. Orders year over year change, obviously dropping as well. So if they're not setting a 52-week low, they're still heading that way as of a couple weeks ago.
Right. Yeah, I mean,
so there's no way possible that this 10,000, the van volumes right now, is sustainable. Is that fair to say, or am I really jumping the gun by looking at this stuff? Because people are looking at this going, okay, what does this is this telling me that all this is just pull forward and nothing's going to happen, or isn't it? That's what I'm trying to get to.
Yeah, so from my perspective, it tells me that if there are increases, and we're seeing the increases in volume, it's telling me that it's not being driven by manufacturing. So that's really making me look a little bit closer at the consumer-facing segment, or things that maybe were on backlog before the pandemic that maybe got pushed to the side. Of course, there's those personal protective equipment, things like that are always going to be in strong supply over the next few weeks and months. But when we're looking at that jump up there, it's not being driven by manufacturing. And we all know manufacturing is a significant mover of freight. So that really makes this a little bit more shaky. And the other thing that makes it shaky is those consumer products. And so this could be driven by consumer products, but the consumer is in a shaky place because come July, those unemployment bonus benefits are going to be ended. They could get extended in August, but those are going to be ended there. And so that's going to be really, really telling.
Well, and hopefully I can find this, but I think it was in Maritime, and I've got 2 points, and I don't want to forget while I'm looking for this other one here. So we're seeing this rise, right? And what we talked about earlier with Zach Strickland on the coronavirus freight market update, and you were on that show as well. Right. Thank you for being on that show. It's always great for you to be on there. But when we're looking at that, you've got, and I guess it's not on this one. I don't have it on this particular dashboard. But the only thing that was up was e-commerce consumer goods.
Yeah.
As far as imports, that's it.
Yeah, and especially
the only ones that were slightly
sales.
green. Everything else that was down that would be sustainable in a productive production manufacturing type of environment, which you need to have going strong for it to be a very strong recovery, right?
Exactly.
So we were looking at those other numbers, and we'll get to this stuff here in a second that I have here on the screen. So we don't need to cut to that yet, but. Those numbers are all down. The production is down. The new orders are down, et cetera. So we have this that is going up. And if we go ahead and show the screen here real quick, what I want to talk to you about here, because we only have a couple, like 4 minutes left, is you're seeing this recovery. And what I have on the left-hand side here kind of extended out so you can see it is the outbound tender volume index, right?
Yep.
And we can see that it has gone out. And the blue mountain is all modes. And then I have it by length of haul, okay? And this was what I was talking about with Zach earlier. The length of haul is changing. The longer hauls are now starting to tick up more, and the shorter hauls, like local and short haul, are starting to drop down, which would indicate movement of DC to DC and less so much to consumer or sales or stores, right? So that's kind of what's going on there. But this is what we're talking about. Does this continue or stay up, this blue line here, or go down? And it is driven by consumer demand right now, or a kind of a pull forward or consumer demand. It's not production that is going on right now. If we see those other indicators and new orders and production start to tick up, I think, in my opinion, I'd like your opinion on this, does this mean that we're heading towards a W down, but maybe it lessens the next trough?
Definitely. I think we've definitely seen the worst trough, most likely in April. And this, of course, is barring any kind of second wave infections or anything like that. I'm just an economist. I don't know what the odds are. Really, I'm going to stay in my lane here. And so let's talk about the econ. But likely, from the economic standpoint, if we keep on progressing as we are, April is likely going to be the worst trough that we've seen.
Okay.
Yeah.
So that's good in the sense that it would be less horrible,
right? Less bad,
which is kind of like what we were talking about. So let's quickly just look at this because we only have a couple minutes left, and I know these things because I can hear it. I'm psychic.
Voices in your head.
Yeah, I'm prognosticating how much time we have left here. So. We have all that, and we're looking for those numbers that can give you strength of indicators of the strength of the recovery,
right.
or maybe the severity of the next trough.
Right.
I would think it would be more kind of indicative, right, when we see those production numbers, because we don't expect to see a 52-week high to a 52-week low in production or new orders to a 52-week high the next thing.
Right.
That would be insane to see that type of recovery, right? So at best, it's going to be probably a lessening of the trough, and we'll ride that next wave up, and hopefully there won't be too many more troughs. But this screen right here is what you were talking to earlier, is this immediate, and what I was talking to earlier is this immediate need for stuff, because when you look at this, the green is up. Mm-hmm. Right? So the green is up. These are volumes up. These are tender rejections up, and so on and so forth. So these are what you need to be looking on a daily basis right now and really be riding and watching those macroeconomic indicators as we discussed today. And we'll talk about them again when they come out. But this is going to help you right now.
Yes.
This you need to be looking at right now. This is telling you the most volatile markets, where those opportunities, where those hurdles are going as far as rejections, capacities, et cetera. And the right-hand side is giving you, even by mode, by refrigerated, by dry van, outbound, inbound tender moves.
Right.
And you can even look at it by lane. So you need to be paying attention to these things and where they're moving. But you need those other indicators to be looking at stuff.
Exactly right.
All those different data sets. Man.
All data, yeah.
It's crazy times. I get geeked out over this stuff. I hate the reason why we're looking at this stuff. But thank you for joining us on Freight Forecasting. I'm Mike Vincent. Until next time, peace and love.